Call options can take your stock market profits on a trip to the moon and are a key financial tool you need to learn. I'm going to show you real examples to teach you how they work and address common beginner misconceptions about options at the end. So what are call options and how do they work? Call options are a financial contract that give you the right to buy shares of stock at a specific price over a specific time frame. Let's see how they work with trade examples in Nvidia and GameStop throughout 2024. At the beginning of the year, Nvidia traded for $480 per share. An option contract giving the buyer the right to buy shares at $500 through June 2024 traded for $50. Nvidia shares swelled 128% through the end of May, while the Nvidia call option increased nearly 1,100%. This means a 10K position in the shares would have grown to 23,000. But a 10K position in the call option would have absolutely bulged to $120,000. This highlights why call options are so popular. The profits from calls can be significantly higher relative to the stock. With Nvidia stock at $1,100 a share, owners of this call option could buy stock at $500, known as the option's strike price. They could then turn around and sell the shares at the higher market price, locking in a $600 profit per share. After accounting for the $50 initial option cost, the net profit would be $550 per share. The key lesson here is that as Nvidia stock went higher, the call option allowing owners to buy shares at $500 increased as they could get a better deal on the stock. But it doesn't always work out as intended. In January 2024, traders who aped into GameStop calls with a strike price of $15 and an expiration of April would have gotten completely rinsed. On April 19, 2024, the stock price was $10.42. The 15 strike call options ended with no real value as the stock was being traded at $10, meaning traders could directly purchase shares at a lower price than what the options permitted. The call option value fell 100% compared to the 37% decline in the shares. This highlights the risk of call options compared to buying shares. If the share price is below the strike price of the call you buy when the option expires, it's worthless. Let's review the key lessons from these examples so far. Call options give buyers the right to buy shares at a specific price, which is called the strike price. All options have an expiration date, which you get to choose, giving the trade a time limit. For call purchases to be profitable, the stock price must increase significantly after you buy the option. The higher the stock goes above the strike price, the more profitable your position. If the stock price stagnates or falls after you buy a call option, you will lose money. And if the share price is below the call's strike price when the option expires, the option is worth zero. If you now think you're ready to ape into calls and get rich easily, you're wrong. There are finer details you need to understand if you want to avoid getting absolutely destroyed from not understanding key ideas. Each call option contract represents 100 shares. When you buy one call option, you're getting the right to purchase 100 shares at the strike price. And if you buy 5 contracts, that represents the right to buy 500 shares. The price you see for a call option is per share, but since each contract represents 100 shares, you need to multiply the price by 100 to get the option's total cost. For example, the Nvidia call option in our earlier example was priced at $50 initially, representing an initial cost of $5,000 per contract. With the stock at $480, buying 100 shares of the stock would cost $48,000. Buying the call option representing 100 shares of stock for $5,000 gives us loads of upside leverage with far less downside relative to actually buying 100 shares. Now, actually using a call to buy shares is called exercising the option. If you exercise a call option, you're effectively redeeming the option for 100 shares purchased at the strike price. Keep in mind, though, that you need the money to buy the shares. If you want to exercise a 500 strike call, you need $50,000 in available cash in your account. But here's the good news. You don't have to exercise your option to make a profit. You can simply sell the option later for a higher price, just like you would when investing in shares. The option's price reflects the potential profit from exercising it, which means you can sell it without actually buying the shares. Very rarely do options traders actually exercise their options. Knowing that options expire, why not buy the longest term options available? The longer the time until expiration, the more expensive the option is, because there's more time for the stock price to rise, increasing the option's value. For example, Amazon shares are currently at $190. The 200 strike call expiring in 7 days is trading for 15 cents. But the 200 strike call expiring in 28 days is trading for $1.52. And if we go a year until expiration, the 200 strike call is trading for $22.80. The pricing of these calls can be understood by recognizing the significantly higher likelihood of Amazon's stock rising to over $200 over a year compared to a single week. These option prices also show us that we'll lose money over time if the stock price doesn't rise. For instance, let's say we purchase a 1-year 200 strike call for $23. If Amazon's share price remains at $190 when our call has only 7 days left until expiration, we can estimate that its price will drop to 15 cents. This means we'll have nearly lost our entire investment. So while buying calls provides massive upside leverage with limited risk, there's also a higher probability of losing money, since you can lose 100% of your money if the stock price remains flat. Let's now address common questions beginners have about options. Do I need to hold an option until expiration? No. You can sell the option any time before the expiration date to lock in a profit or limit a loss. It's like a coupon. You don't have to hold it until its expiration just because it has one. What happens if the share price is above the call's strike price at expiration? The call will have value equal to the difference between the stock price and the strike price. If you hold it through expiration, it will automatically get exercised. So it's recommended to always close options before expiration. And who is going to buy my call option when I want to sell it? It could be a market-making institution or other investors and traders in the options market. If you're trading popular stocks and ETFs, you'll have no issues closing your option when you want. Leave me a comment with your questions below if you need clarification on anything. My name is Wealthmore. I hope this video helps your options portfolio absolutely bulge to new heights.